Okay guys, so welcome to this video where we're going to have a look at trading the European stock market index and the German stock market index and how we use the manufacturing PMI data to get an idea as to when we want to be buying the index or selling the index on expectations of economic growth in Europe or in Germany. So the most important thing we have to understand, the index represents the biggest companies within Europe or Germany. And overall, if we expect economic growth to expand and the economy in Europe to be growing, then we expect the companies within Europe to be earning higher profits because we're in an expansionary period of growth where people are earning money, spending money, and businesses are investing in their in their goods and services. And that is a situation where you have low unemployment because people are going into work, there's economic growth, and stock markets go higher during levels of growth expectations. So we're going to look at the European index. We're going to look at the German stock market index, the DAX, and we're going to have a look at why over a 2-year period, the German index and the DAX didn't really go higher over 2 years, only by 4%, whilst the US stock market index completely rallied by another 20% over that 2-year period. And it was expectations of growth in Europe and in Germany was not positive. And I'm going to show you how the economic data, the manufacturing PMI, was telling us this indication. And that's why investors were not buying equities in these two regions of Europe. So remember, equities are just stocks, just a different name you use for stocks. You call it equities. And now we're going to have a look at how we analyze whether Europe or Germany is going to grow. So manufacturing PMI data is a leading economic indicator that all investors focus on. It's the most important economic indicator on the monthly calendar. Central banks monitor it very closely. Governments monitor it very closely. And then you get investment banks, hedge funds, all use this to know when to buy a stock market or to sell the stock market on expectations of growth. So if you have a situation when the economy is growing, then as I said, a growing economy is when people are spending money, the goods and services that are being produced in that economy are going up in value. So GDP, gross domestic product, is literally just the value of everything produced in a country over an annual 12-month period. So if the companies within that country are producing more goods, more services, because there's a high demand, then there's inflation as well that raises the price of these goods and services, then the value each year of everything being produced is going up, and you have then positive GDP growth. So how do we know when an economy is going to grow or contract? Well, we have to look at the manufacturing PMI data, which is a leading economic indicator that predicts GDP growth with an 85% certainty when we look at the data going back in history. So here we have the European manufacturing PMI, and then we have GDP growth highlighted in red. So what the manufacturing PMI is telling us is when we have a reading below the level of 50 and contracting, this means that GDP growth in Europe is predicted to be negative. And when we have a manufacturing PMI report above the level of 50, this indicates there's going to be an expansion in growth within the European economy. So if you have manufacturing below the level of 50 and contracting, so going lower and lower, we're predicting even bigger declines in GDP growth. And that means the markets are betting that growth within Europe will be negative and the companies will be earning less money over an annual 12-month period, because for there to be negative GDP growth, the value of everything being produced has to be going lower. And then when we have manufacturing going above the level of 50 and growing, that's indicating the company is going to be earning more and there's going to be an economic expansion. So what you can see here is when the manufacturing PMI went below the level of 50 in 2008, negative prints of GDP started to come out on a quarterly basis. And then when the manufacturing troughed and started to rise again, indicating that growth would be returning, and then we went above the level of 50, you see GDP growth then started to be positive. And you can clearly see there's a very strong correlation between the two. So here you can see even more strongly, manufacturing is above the level of 50 and then it starts to expand. So on a monthly basis, the reading could go from 52 to 54 to 55 to 56 to 57, 58, 60. And then look, GDP then starts to grow on a quarterly basis. We get more positive prints of GDP. And then the manufacturing PMI data peaks and starts to go lower, indicating growth has peaked and the growth cannot get any stronger. And then the manufacturing data starts to decline, meaning that growth is predicted to decline over the next 12 months. And then what happens? GDP starts to decline as well. So you can clearly see the manufacturing PMI data is used to bet on over the next 12 months whether the economy is going to grow or whether the economy is going to contract. So that's a very good snapshot of how manufacturing PMI data is used to bet growth in Europe as a whole. And then we have Germany's manufacturing PMI data, and it's exactly the same. So again, from 2016 to 2018, the manufacturing PMI was predicting growth. Then we had positive prints of GDP growth in Germany. And then when the manufacturing data was declining, the GDP data started to decline as well in the market. So you can clearly see a very strong correlation between the two. Again, when it's below the level of 50 and contracting, we had negative prints of GDP. So what we're looking at is for growth to be PMI data to be above 50, and we're indicating growth in the economy, below 50, contraction in the economy. And what I can show you is that between 2016 and 2018, when we're looking at, say, for the German manufacturing PMI, let's look at the German index. Between 2016 to 2018, what do we see in the manufacturing data in the German stock market? We saw the stock market rally by 40 to 50% over those 2-year period. And why was that? That was because the manufacturing data was telling us that growth was predicted to be increasing, and then GDP was increasing. So then the markets are then going to buy the stock market in anticipation that if the economy is going to grow, the only way the economy grows is if the biggest companies within the economy are going to be producing more goods and services, and inflation will be rising, increasing the costs of these goods because of the high demand. And then we get a situation where the stock market investors, or investment banks or hedge funds, they start to buy the biggest companies within the German 30 index, because they know if growth is going to be happening in the German economy, then the stock price of the 30 biggest companies in Europe are going to be increasing. So they buy the stock market, and we get a 50% increase in the German 30. Then we can look at the European stock market index, and we look between 2016 and 2018, we see the same picture. European stock market was rallying over that 2-year period, and that was up around 40%. And there's no surprise that when we look at the manufacturing PMI data in Europe, again, between 2016 and 18, it was rising. So investors were buying the European stock market and buying the stocks within the European index, the 500 biggest companies in Europe, because they knew that if GDP is going to be expanding, that's because these companies are earning more profits from the higher demand. There's inflation in their prices, and they're producing more. So the value of everything in GDP is going higher. And then in 2018, you could see the European PMI started to go lower, indicating growth was going to be contracting. So then straight away, investors didn't want to be buying the European stock market, and that's why it went down and then went back up. But overall, over a 2-year period, it only went up by 4%. That was a tiny increase, and that was because the manufacturing data was declining. But at the same time, it wasn't below the level of 50 until 2019. So because it was still above the level of 50, even though it was declining, it just means growth is not going to be as strong as before. Whenever it's above the level of 50, there's still going to be growth, but it won't be as bullish as when it's above the level of 50 and increasing. And there you have it, why the stock market was only up 4%, where before it was up 40%, because the manufacturing PMI between 18 and 20 was declining, indicating lower levels of growth. The same situation in Germany. Manufacturing PMI was declining from 2018 to 2019. And then the German index, again, you can see the German 30 index over that 2-year period didn't rise at all, or went up 2%. For an example. So you can clearly see the markets use this as a very strong indicator to when to buy the stock market. And if we look at these, if we look at this, you can see how closely correlated the two are. So here, highlighted in blue, you have the stock market index over an annual 12-month period. Then highlighted in red, you have the manufacturing data. And look how closely correlated they are. So when you get the manufacturing below the level of 50, you get negative year-on-year growth in the stock market. When it's above the level of 50, positive year-on-year growth in the stock market. So you can clearly see how strongly correlated the two are. And we can see exactly the same situation in Germany, how strongly correlated the two are in this example here. So if you want to be buying the stock market, now you know we want to be looking, is the PMI data above level of 50 and growing? That indicates growth is going to be happening. So then markets are going to go into, investors are going to go into the stock market, buy these stocks, and that's going to raise their prices from the high demand, people buying them, and the index rises as a result. And if the PMI is contracting or above 50 but going lower, we know that growth expectations are declining. That's not positive for stocks, and we don't want to be buying stocks during that kind of period of time. So most importantly, where are we right now? The European index is above the level of 50 and growing. So that means that Europe is predicted to grow over the next 12 months. In Germany as well, we are above the level of 50 and growing. So Germany's stock market is predicted to be positive, and that's why when we look at the German 30 index, has now made all of the losses back from the early parts of the year, and we're predicting that in the next 12 months the stock market will continue to rally. So we're looking to buy this index as long as the data in the manufacturing stays above the level of 50. And the same could be said for Europe as well, where Europe is now retracing the recent sell-off, and if the manufacturing PMI data in Europe stays above the 50, we want to be buying the European index as well. So I hope that makes sense, guys. And that's an understanding of how to trade stock markets. Thank you.